Good evening, ladies and gentlemen. Welcome back to the video studio of CFA Association Russia here in Moscow. And we come back with our monthly, almost monthly macroeconomic overview. As usually, we welcome on our live webcast everyone, all the financial community of Russia, the CIS and the EMEA region, but the recording will be available only to members of CFA Association Russia and to members of several CFA societies worldwide. Now, as 1 month ago, I'm very pleased to welcome back the CIO of Blackfort Capital from Zurich, the portfolio asset management company. Let me welcome Andreas Bickel, the investment professional with over 25 years in the financial markets, former head of portfolio management at Goldman Sachs, Switzerland, and the Rothschild Bank, Switzerland. And hello, Andreas. Also, well, as we are now in the middle of the two processes, two events which have very high impact on the markets in all regions globally, the US elections and the second wave of COVID, there definitely are going to be many questions that investors will pose today, and there is a lot to hear from you. I remind our viewers that there is a chat box. You see the chat sign on the screen. Please use it to post your questions, and we will ask those questions to Andreas throughout the broadcast. So good evening, Andreas.
So good evening from Zurich. Thanks a lot for having me. Let me share, as usual, my screen with you. As you probably have seen from the invite, there are two main events to be discussed. One is the outcome of the US election and its impact on the market. The other one is, unfortunately, worldwide, the second wave of the COVID. And in the US, we are even talking of the third wave of the COVID. Therefore, this must be tackled, and its impact or its expected impact on the outlook of GDP, but probably more important on markets in general. As always, I come back to key stimulus factors, which are monetary and fiscal. And at the end, I will show you where I believe forward-looking we might have interesting or still interesting return opportunities. With that, let me share you my first overview slide. As I have been here several times, I thought it is high time to summarize what I have said in one slide and to talk about it square by square, and try to explain why I think these four squares make sense if they are used all together in an appropriate way, and intonation especially, because at the moment I would still argue for the US that the fiscal stimulus is too weak or not yet decided. But let's start from scratch. I mean, we have monetary stimulus. And as you all know, when the COVID started in March, the Western world immediately put monetary stimulus at work. The effect was that asset prices didn't fall as much and recovered fast, but there was no inflation. And in China, however, they did the opposite. They first tackled the COVID situation, then they implemented fiscal stimulus and adjusted the monetary stimulus. And they are now out of the recession. They are almost having no COVID cases anymore. The service sector, which we have, at least in Europe, partial lockdown, and even in the US, cinemas as an example, theaters, etc., are all closed. They are open in China, so they did it differently. Obviously, they have a different system. In this system, if the government says there is a complete lockdown in a region, there is a complete lockdown, there is no exception. But once they open up, there is also a full open up. So monetary stimulus is the base. However, it was not sufficient since 2009. And I continue to believe and to repeat, monetary stimulus is not the medicine for COVID. It is a needed instrument, but it's not all. What we have seen since 2009, and we will see in some minutes in slides, financial repression. The only thing this time what they achieved was that we see nominal negative yields in the Western world, with the exception of the US from the larger countries. There we see only real negative yield. But we don't see inflation and we don't see investments. Why? We had that in our last webinar. Balance sheet recession. Basically, what we mean by that is that the private sector, in particular private individuals, but also corporates, privately owned, they do not invest. And if they get windfall profits like the helicopter money in the US, they save it instead of investing it. I will show you also 2 slides on that. But even that is not enough to get it up and running. And why? Because there is fiscal stimulus missing, and especially there is fiscal stimulus missing which arrives in the real economy. As you will see down the road, the implemented fiscal stimulus was mostly saved by private individuals. So we are back to the square at the bottom left-hand side, balance sheet recession, and was not invested into the real economy. And if so, it was rather used to play around in the stock market like the Robin Hooders did some months ago. What for me was striking, however, is what's written underneath. We had a very similar situation after World War II. So first started with the Great Depression, which was not tackled by the Fed. By the contrary, the belief was laissez-faire, don't intervene too much, don't stimulate the market with monetary stimulus. Down the road, however, more by a coincidence, but still down the road, the New Deal, they did fiscal stimulus and they did financial repression with yield curve control. And therefore, this is a case study up till 1952 that all the ingredients which I have put above in this box are actually or were actually used after World War II. And we know what happened then. I mean, we had a tremendous rally, we had a tremendous growth, and it solved the problem after World War II in the US, where there was almost no destruction from the war, but in particular in Central Europe. And as a main example, it is Germany, where the Americans and the Allied invested everything they could to have the economy up and running. So therefore, if we were to see the 4 ingredients in the US, I would strongly recommend everybody not to bet against the recovery of the market, and the GDP development will surprise to the upside. With that, let's go step by step. We know that there is fiscal stimulus, and this is just an update. But basically, we see that the Fed, the ECB, they both have decided in different way, but they have decided to be more expensive down the road. The Fed statement last week and the ECB, they both said, if there is need for more, don't worry, we are here to help. Similar in the UK, similar in Australia, maybe not so important. But one thing is different here. In China, they started to cut the monetary stimulus because their economy runs at high speed, and they have fiscal stimulus on top of it. But this ingredient, I would say, is a given. But as I said several times, and sorry for repeating, it is a conditio sine qua non, if you want, but it's not the sufficient one. Here you see forward-looking in Q3, the already implemented and planned QE purchases or bond purchases program of the four major central banks. Q4, this is what we know so far, and next year what is planned, but most likely this will surprise to the upside. So there is almost for sure more QE ahead of us. You see it also here. Here, this is the aggregated balance sheet of the 10 largest central banks in the world, 12-month rolling balance sheet. And you see that we have really skyrocketed since March, and it has accelerated since August. One of the key conclusions I would draw from this is that all this money printing will down the road inflate asset prices, and therefore, to quote Etiardeni for another time, this might be just the mother of all asset melt-ups ahead of us. With that, I have already set the scene. I keep this, and I've said this several times in the past. I believe that this actual rally, which is ongoing since March 2009, will end in euphoria / in tears. And to happen, we need to see a melt-up in financial markets and financial prices. What this monetary printing did produce is this. This is globally the total amount of negative yielding government bond yields. So we are more than 17 trillion, higher than last year. Obviously, it helped, in brackets, it helped when the COVID broke out. We had a halvening of the figure, but in the meantime, we are back to record levels of negative yielding bonds. And be aware of it, that's before inflation. So one thing they really did, they managed that the bond prices stayed at high levels and yields low. However, since March, this is the yellow line, they achieved something else. In the US, the real yield, so treasury yields subtracting the CPI, is now at roughly -1, and since yesterday, maybe at -0.8%. So they managed that also in the US, we have financial impression, but not like the situation was after World War II. It is in real terms and not in nominal terms. Having said that, that means basically that on top of the 17 trillion from before, it comes all the treasury bonds from the US. So if the Chinese, as an example, or other central banks hold US treasury, and they are the main holders of them, because the Fed only has roughly 22 to 25% of all outstanding treasury on their balance sheet. The rest is mostly held abroad. All these investors, they are losing money if it's adjusted for inflation. So financial repression and monetary printing works, at least from this angle, but it's not really the main goal. The main goal would be to have also inflation and a strong growing economy. And both were so far not achieved. Here you see the 10-year real yield of the US in historical perspective, and you see the two oil shocks in the 70s. So -1, you can go lower. You can go -4. I'm not foreseeing this, but I wouldn't be surprised if down the road we see more than -1%. This is actually putting us all in a difficult position, because we are here to preserve capital. So if you buy government bonds across the globe, you basically get an asset which doesn't give you a return, but gives you a certain risk. Also on the corporate bond side, the line at the bottom is the global investment corporates, it's the right-hand scale, is yielding roughly 0.4%. And you see there's the sharp drop in line, which means a strong rally in bonds over the last 10 days, like in equities. So since we have last met, you were to make a lot of money if you had investment grade corporates in your portfolio. But 0.4% for a corporate bond in the BBB single A area mostly before inflation is definitely not a good investment. On the other hand, you see, for instance, in the light orange, 4% roughly for US high yield, a bit less for hard currency emerging market bond, corporate bonds, and for global, a touch below 5%. So there is in this area still some value, but we are basically back to pre-COVID crisis level. So I would expect that the compression of spread is mostly over, assuming that this stimulus we are talking about will create a certain growth, and also assuming that the monetary stimulus / bond buying program continues. You can earn here the coupon, and we are still positive and invested in corporate bonds. But obviously with 4 to 5% nominal yield, these are not the great investments they used to be 4 years, 5 years ago, or even after the 2009 crash. I mean, there you got 15%, 1.5, and now you get between 3 and 5. It's definitely not the same. But compared to other areas in the liquid space, it's probably still a place you can deploy money. This slide we had last time. I'm just coming to the conclusion. Fed, ECB, and others said lower for longer, and we want the inflation to float around 2%. In the ECB case, it's not yet decided, but they are discussing it, that they might go a similar path than the US. But both central banks have urged for fiscal stimulus. And I said, and this anecdote from last time, in 2009, when we had the aftermath of the financial crisis, the US did two things. They did financial repression, if you will, but they did monetary stimulus and they did fiscal stimulus. What I didn't know until 1 month ago is that the inventor of this theory of balance sheet recession had, before the Congress and the Fed decided to stimulate via fiscal measurements, they had a meeting together, and Bernanke admitted to Mr. Koh, who is the inventor of the balance sheet recession theory, that he knows that the only way out is through stimulating on the fiscal side. And it is a bit ironic, but in 2009, the crisis started in the US. The US was out the first of the crisis because of both measurements, fiscal and monetary stimulus. History doesn't repeat, but it rhymes. It's an old quote, I know, but guess what? This spring in China, they did exactly the same. They did fiscal stimulus and then adjusted monetary stimulus, and they are out of the wood. I mean, the economy is going well. The latest figure from an acceleration, while in the Western world we are struggling. We are dealing with the second wave of COVID, etc., etc. But also here, it started in China, and they are the first country to be really out, together with other countries placed in Asia. And here it comes. This is why I'm really, really positive for the near-term outlook of the economy, and with it also for financial markets and prices of assets which trade there. You see, really surprisingly, the biggest stimulator in percentage of GDP is Germany at the moment. So new fiscal measurements, that's the light blue, is the highest, or one of the highest. Together with the fiscal guarantees, Germany has committed themselves to 35% of GDP to stimulate, or indirectly stimulate through guarantees. Italy, the same. Difficult to find how they want to finance it, but at least from that angle, also Italy has probably a better future than the recent past. Japan is here. Obviously, Japan is implementing Abenomics, although the prime minister is not there anymore, and they are doing both because of Mr. Koh. And we see the US. The US has still since August pending the fifth package, and the fifth fiscal package might only come once Mr. Trump is really out of the office. That will be roughly around the 20th of January. Interesting enough, it's also an anecdote. I think it's fascinating. Mr. Bernard, the guy who leads the Republicans in the Senate, and Mrs. Warren, who does the same in the House, they have discussed before the election about the package, and the Republicans always said, no way, the deal cannot be so big. We will only do this maybe next year, only after the election, etc., etc. 24 hours after the announcement that probably Biden will win, or at least leads, the Speaker of the Senate changed completely and said, I think it's possible that we will do a deal until the end of the year. And rumors are that also this Pfizer news yesterday, where they deliberately said the announcement date has nothing to do with the US election. In both cases, it's at least amazing and astonishing that once you have defeated Trump, only then this news, which would have helped Trump in the election phase, come out. And there are conspiracy theory that both deliberately timed this good message after everybody has voted. If that's true or not, we will never find out, probably, but it's remarkable. The key message, however, is very simple and straightforward, and you will see that also in a minute. Disregarding who is president, but it seems definitely that it's Biden, disregarding in which who is leading the parliaments. If it's divided like now, they call it gridlock. That's actually the best outcome from everything. So disregarding of any possible combination, we will get fiscal measurements. Therefore, the four ingredients I started at the beginning are probably going to be in place in the next 2 months. However, it is key that the fiscal stimulus is done in a smarter way than it was done in March. You see on the left-hand side, the light blue line is the cumulative fiscal stimulus. So in America, everybody, as an example, got $1,250 as an adult and $600 for a child. And in the darker blue line on the left-hand side, you see how much of this money actually was saved and not spent. And here we are back to the theme balance sheet recession / the private sector is saving and not investing. Therefore, if we were to see stimulus, and this is extremely likely, it has to be done in a way that it creates growth, GDP, and investment. So the American have a infrastructure which is really dated and needs update. They have very slow internet. They have not all-around coverage. We have a disruptive economy at the moment, so digitalization. As I speak, you see I'm at home again. I was in the office, but this has changed. So if you invest in such kind of things, there will be growth. The other good news is on the right-hand side. You see that a lot of startups were during this lockdown period created. That's the orange line. Startup doesn't mean that all will succeed. We know that. However, it is encouraging that people start new businesses, and this keeps also a positive stance for the future. Here you see the chart which I've shown the last time. I found it amazing that the light blue line shows what you could spend on your credit card, and the white line what actually was spent. And you see that there was a huge saving. And this is definitely putting a problem to the economy, because you need people to spend and to invest, that you create growth. And here we are again with balance sheet recession. and you need to have an investor. And if the private sector doesn't invest, it's unfortunately the state which has to invest. And therefore, we are back to the fiscal stimulus, which has to address this issue. With that, we come slowly but surely to COVID and the outlook for GDP. As you can see on the left-hand side, the latest forecast of the European GDP development is a double dip. We have partial lockdowns in almost all countries, but partial lockdowns. On the right-hand side, you see, compared to the shock in March, April, May, the impact is limited. However, around 50% in most bigger countries, with two exceptions. One is the UK, although here I have to say they have in the meantime decided to have a lockdown, so this figure will go up. And the other one is the US. The president-elect Biden said, guys, please do have social distancing and have a mask on. Masks are not here to make political statements. They are here to protect us, the society as a whole. If they will follow, we have to see. However, what it means, bottom line, is that the still largest economy in the world has only a partial lockdown and is still running at a pace of around 2%, which is remarkable. In Europe, you see the impact of the COVID lockdown Q4 on the left-hand side. So it drags substantially GDP growth. On the whole area, more than 2%. The worst is France. Spain is also more than 3%. And more shocking is the forecast of the rebound next year, Q1. And as you can see, Goldman Sachs sees the best 1% plus. Having said that, I keep to be skeptical about the Eurozone, but I also admit that I'm positively surprised by the central bank and by the fiscal stimulus I have shown before. I still prefer other regions to Europe, but I would say for once we cannot say that most governments in Eurozone are not doing a good job in terms of stimulating through fiscal and the central banks through monetary stimulus. If it were to be so bad as shown here, nobody knows. The US, independent of who is president, this was done before the election, and who leads the Senate, basically in all the situation besides uncertainty and you don't know who will be president and how it looks in the both parliaments, we will see growth and not really a slowdown into Q1. The most likely outcome is that at the beginning of January, the majority in the Senate will be the Republicans, and we have Biden. And with that, we have the third best scenario shown here. I slightly disagree with the analyst because I believe that Biden gets a bit more stimulus done than Trump wanted to approve. But future will tell us. But it definitely means there is stimulus and growth ahead in the US. What is also interesting and positive, if you believe in the forecasting power of bond markets, you see here in the green line, the new measurement, 10-year yield treasuries minus the 3 months, and in the orange line, you see the traditional measurement, 10-year yield minus the 2-year yield of treasuries. Both have significantly increased. They are approaching 1%. My guess is that the recession is probably over in the US. So there was a really deep recession in Q2. there was a strong recovery in Q3. I mean, figure-wise, the way the Americans put it, we had minus 35% in Q2, and we have had plus 30 to 32% in Q3. This is a bit misleading because basically they analyzed the quarterly figure, but we are almost back to levels we started the year. And if the forecast were to be right, that Q4 will be plus 2%, then we are back to where we started the year in the US. So this gives us a hint, and I believe that it is really an extreme likely scenario that the US recession is behind us. But there is an elephant in the room. We all know it. It's COVID. The problem here is that Europe is really not having it under control in terms of new cases daily per 1 million inhabitants. You see the Eurozone as a whole. We have, if I call Switzerland as well to the Euro area, I know we are not, but we have even more cases than the Euro area if we do daily cases per 1 million inhabitants. So it's really a scaring picture if you just look at this. We have overtaken the US, although they are also accelerating. But now it comes the big difference. In the US, we have growth. We have no lockdown. I would accept that if you were to tell me the COVID crisis is not managed in the US, fully agree. But on bottom line, I must also say that the US keeps growing, although they have these cases. While in Europe, we will have almost for sure a double-dip recession. Interesting for me at least is that you see the purple line Brazil. They also poorly managing the situation of COVID, but the number of cases is decreasing. And similar in India. I mean, in India, it is difficult to really know, but probably more than 60% of the whole population was infected. They had a lot of debt, but also there in these four hotspots 2 months ago, we see significant improvements, although there is still no vaccine and they do not handle it properly. Therefore, this is also positive for the outlook. Last but not least, I mean, you see China, or actually you almost don't see it because they are below 40 cases, total cases per day. You don't see Korea. It's also basically at zero. You don't see, because not drawn, Japan or New Zealand. There is a very similar situation that the number of new infected people is reaching levels below 50 a day. So what's the problem? I mean, the problem is that the health system in the US, in the Eurozone, is not handling the people who get into the hospital. That's basically the problem. It's very unfortunate if you're in such a situation. But if you go a step back and you just look at growth figures, it is sad to say, but the US has kept its country open and it keeps growing. And China has had a little blip in spring. In the meantime, they are having it not only under control, but really are outpacing the world with growth. Why I'm not really bearish is this. You see here the percentage of GDP, which is leisure and transportation, which is hit the most in these shown countries. And you can see the hardest hit is Spain, but even there, it's around 12 to 13% of total GDP, which is hit. So accommodation, food services, I strongly assume they have put in tourism as well, also in transportation. The rest is more or less working. Even if they have a curfew, and they have, you must go working. Maybe the schools are closed like in Italy, like in regions in Spain, but the economy, the rest of it is still growing, or at least working. Let's say working. Growing is probably the wrong expression. And to me, surprising, if we defined the service sector by this tight measurement, you can see that it is less than 10% affected of GDP. That explains partially why we can expect growth in the US. It's very unfortunate if you are an artist, an entertainer, maybe you work as a musician for the Philharmonica in New York, etc., etc. They are really, really badly hit. But if you turn it around and just look at figures, the rest of the economy is doing pretty well, although the situation is definitely not under control. Where will the markets go? This is a normal chart showing the performance before and after election. It was done more than 3 weeks ago, so you are here actually is wrong. We are a bit more to the right-hand side, and we are actually 10% higher than when this chart was drawn. All these measurements I've mentioned at the beginning, in particular financial repression, so negative yielding bonds, or at least real yields are negative, nudge people to put money into investments and into the stock market. This is deliberately done. I wouldn't be too bearish about the future. Yesterday, for instance, after the announcement of Pfizer and the biotech companies, or the conglomerate, markets basically went crazy. And there was a sector rotation which was brutal. So tech is today down and yesterday down, while Russell 2000, small caps, value stocks, leisure stocks, transportation, airports were up yesterday between 5 and 25%. I would call it irrational exuberance, knowing that this is stolen from former Fed chair Greenspan. But just think for a moment. Until the end of the years, in the best scenario, there might be 50 million vaccines. And next year, in the best case, there might be 1.5 trillion vaccines. And then you put that into perspective with how many people need a vaccine, and you immediately see this doesn't really match. So until spring, the situation will only partially get better on the COVID front. Therefore, for me, unexplainable if you just look at forward-looking returns and you discount it down. Obviously, it was a herd moving, it was all the short sellers, but down the road, I would be careful to be overweighted in that area. But it also showed us one key thing. There is light at the end of the tunnel, as simple as I can put it. And as soon as the market believes there is not only light, but it's also achievable, it is immediately priced in. And normally it happens what happened yesterday. There is first an overreaction and then a normalization. Today, as we speak, or at least when I started, the US markets were flattish to slightly down, but Europe keeps catching up. This is due to valuation, and we have a lot of sectors which are hardly hit by the lockdowns. I would argue that this will mean revert over the coming weeks, and we probably will see a sector rotation, but I would not bet in for instance, transportation, entertainment, etc., because most countries have definitely decided there will be a lockdown, theaters will be closed, etc., till spring. And even with this news yesterday, the situation hasn't changed. Midterm, however, this is a really positive news, in particular, if it's confirmed that the effectivity is 90%. So if you take the vaccine, 90% of all these people who got the vaccine did not get the COVID illness. And this is extraordinarily high according to experts. I'm not such an expert, so I keep repeating what I've heard in the news over the last 24 hours, but it's encouraging. The key question obviously is, does it matter who is president? And the answer is not at all. I have shown here a chart I found in another publication. It shows the Dow Jones since 1937 till 2019, disregarding who is president, who has the lead in the two parliaments. The returns for both president of both parties is basically identical. If you do this chart with the S&P 500, starting from 1932 till also last year, the difference is larger. There, however, if you were to adjust for the dot-com bubble, the situation is equal to what is shown here. On average, markets perform very similar under both possible outcomes of a president, which I found amazing. If you read research and newspaper, normally you hear something else. Here is the chart I mentioned before, performance since 1932. Excluding what Bush Jr. had to suffer and the Watergate affair, the return is almost identical at roughly 9.8%, similar to what we have seen before. If we were, however, to include the whole period, and the S&P is a bit better constructed than the Dow Jones, we could actually conclude that Democrats are good for markets and not Republicans. And that is a bit amazing, at least for me. A word of warning, I joined a webinar from Bell Capital. What they did on the left-hand side, the blue bars, this is Shiller P in the box performance range. So when Shiller P is a bit above 15, if Shiller P is below 10, the average forward return is roughly 15% over 5 years. If, however, on the right-hand side, the light blue bar, we are above 40, history, according to this data mining, tells us the return over 5 years is rather negative. If we were to see what Shiller wrote in his paper, the conclusion is over 10 years, the real return in S&P is between 1 and 3% positive, significantly lower than the long-term return of 6 to 8%. So the forward-looking return for US market is definitely below average, but now it comes to but. The short term can obviously differentiate from this mid to long-term outlook. And the short term is overlapped by the different stimuli I said in the beginning, by the financial repression. And last but not least, we live in a disruptive environment where we have a complete changement to industrial 4.0, 5G on the internet side, digitalization. As we speak, maybe most of you sit at home and not in the office. Normally, probably we were to meet in a room and the speech would be given, and afterwards we would do networking. As you see, at this time, it is completely different. What this all means is there will be winners, and some of them are the FANG Plus stocks, but not only. And there will be losers. And I quote again Ed Yardeni, a strategist who is around for more than 35 years. He basically said this reminds him to a certain degree what happened with the economy during the Roaring '20s. And we all know how that ended. And if you follow that narrative, which fits to my narrative, although I came from a complete different angle, we were aware to see first a melt up before we see a correction, and then probably the forecasted expected chiller PE return might materialize over 5 to 10 years. But the path, I would guess, and it's unfortunately a guess, nobody has a crystal ball, but I would guess is first a strong move up, or as I call it, a melt up, before the huge step down. Earnings. I mean, I found it fascinating after more than 25 years in the market. Q3 earnings, more than 80% have beaten their estimates from bottom-up analysts. And if you were to add the meat, we are almost at 90%. Astonishing. Not unusual after a recession, after a correction. Marketplace that. The forward-looking return for next year is interesting. For the tech sector, the expectation is only a growth of 14%, while for instance, industrials, the expected earnings growth is of roughly 75%. And for the whole S&P 500, we are at the moment at 21%. Having said that, most likely in Q1, we will see the same game again, that more than 75% of all companies will beat the estimates. Therefore, this is another positive for market, although it's a bit artificial. Last but not least, for me, amazing, the Eurostoxx 600 index has seen, in terms of earnings, 70% roughly who have beaten analysts, and in terms of sales, which is probably more reliable in these times, even there, surprisingly 54%, so more than 50% have sold more than analysts have expected. So even in Europe, and you know, I said it several times, and I keep now saying it again, I'm not bullish on Europe, but even there, you see a certain growth, and you see in particular that equity analysts and economists, and to a certain degree, corporate bond analysts, they are too cautious, too bearish. That's human behavior, but just take that into consideration forward-looking and when you're investing. This chart I have shown in the past several times. There are two messages. One, the amount of money market investments is decreasing, but still huge. The shocking bit is it went into shown government bonds and corporate bonds, also shown equity investments, haven't seen any significant inflows. It went also in houses and in art, etc. But definitely equities are a hated asset class. They are hated since March 2009. And there is still no euphoria. If I keep telling people I believe this market will go up, I see the anger and the disbelief in the eyes of people. At the moment, unfortunately, I cannot see you, but excuse me for a second, but this is positive, at least for the scenario. When the shoe-shining boy tells me, or the taxi driver, or a cleaning woman, or whoever who is not from our industry, what I should buy, then I'm really, really worried. Did you know yesterday we have seen all-time highs in Nasdaq, in S&Ps, in Dow Jones, and in the Russell 2000? It's no headline. It's unnoticed. And it was also brutal because people were shifting around their assets, and yesterday suddenly things which were short were going through the roof, and things which were working well so far, like staying at home shares, were crashing. Well, crashing is a big word, but down 5% on average, which is quite amazing. So the US is one of the most difficult markets in the world, but if such rotation happens, I personally do not know any active investor who is able to foresee that and to outperform. However, there is a cure for that. It is probably not fancy. It's not really something you can make a big story out of it. But if you where to buy the broad market by the S&P, some tech by the Nasdaq, and maybe some Russell 2000, or you just buy the broad US market year to date. You were either flat or significantly up. And if you have a combination of the 3 or 4 indices through ETFs, I know, but if you were to have, you would have a decent return. And all of you who do the CFA, you know that every year the statistic, if it's a good year for active manager, only 60% underperform. If it's an average year, more than 70%, and sometimes even up to 90-something% happened recently, underperform. I, at least for the US equity market, prefer to play it simple through ETFs, to diversify through different segments, sizes, styles, etc. And this has served me well this year. Sorry, wrong direction. With that, I come to the conclusion, but let me first share this with you. Here is year-to-date the performance of various equity indices. And basically, you see here what I've just said. You see the yellow line is the Nasdaq. So year-to-date, definitely one of the winners, no doubt about it. You see in green the S&P 500, which is to more than 25% driven by tech stocks. But you see also Europe, that's the orange line. We are still down, depending in which currency, between 9 and 10%. Not shown here, no, actually shown, the red line is Asia. So Asia is also, as a whole area, up. And this compares to the last one, which is Latin America. I believe I said last time, if you're a risk taker, it could play out to buy Brazil. Let's take the performance since the beginning of the October. You had definitely a roller coaster. You had at the beginning of the month a sharp drop, but since then and over the whole period, you would have done a decent job. Therefore, if we come now to the conclusions, they are similar to what I've said before. One thing is definitely different. Short term, I think markets have overreacted due to the COVID news of yesterday. This will regulate through the coming trading days. Nevertheless, it also teaches us the lesson that the market is looking through the drop of GDP and earnings in now Q4 in Europe and across the globe. We are pricing in what's happening mid next year. We don't know that, but since yesterday, it is probably fair to assume that the future is brighter than what we have seen over the last 9-12 months. Therefore, stay invested, rearrange your portfolio. I keep preferring equities over corporate bonds. The intonation is changed. I see more value in Asian equities than in US equity. 2 reasons. One is valuation and the other one is growth outlook and the status of fighting against COVID. I kept the LATAM trade here, which is basically Brazil. All this obviously makes only sense if you believe, and I do, that the US assets and the rest of the world is protected by various central banks' measurement, and there will be fiscal stimulus in the US. I strongly believe so. Therefore, US high yields, we saw the chart before, and emerging market corporates, they still offer yields of 3 to 5% if you are lucky. This is not really great, but the alternative is definitely also not compelling. I mean, investment grade globally 0.4% before inflation US Treasury since the rally yesterday, 90 bips before inflation. The inflation stands above 1.6%. Do the math yourself, you lose money. Therefore, these are the main calls. Amazing enough, yesterday we have seen a sell-off in gold. This can only be explained by the strong move into the other sectors and the up move. The gold chart is now unfortunately below the 100-day average. I keep gold on the list. I think it plays a role in the portfolio at the current environment. I strongly believe that the the Treasury yield will not go up significantly above 1.2%. The Fed will start buying longer bonds and pressure the yield down and the prices up. Also, the disclaimer or the risk is very similar to what I've said previously. Assets, at least the ones I've mentioned, none of them are cheap, maybe with the exception of European equities, value equities, but there I would always add they are cheap for a reason. The impact of the fiscal cliff, or will there be a fifth package? Everything we know before the election and now, the answer is the two parliaments together with the new president-elect, they will agree on a package. It will be less than what Biden would do, but it will be probably bigger than what Trump was willing to give before the election. This will stimulate not only the economy, if wisely done, but also fires up more for financial assets and prices. Midterm, my warning is still here. I have used for the second time the picture Mr. Yardeni says. I call it a melt up. He makes a parallel to the roaring 20s. Choose your picture, but I strongly believe as long as we see fiscal and monetary stimulus across the globe, there won't be a real severe crash, a bubble bursting. But I can also not tell you that we are not in the process of building a bubble. By the contrary, I believe we are in the midst of it. With that, I'm through and open it up for questions. You have to unmute. Still unmute, please.
Yes, we don't have too much time remaining for the questions. Although if more questions will come, we will ask them to Andreas. But the one thing which is of interest to most viewers, obviously, in our region is the emerging markets, how they will feel in these times, and emerging markets as such, different emerging market regions, but also Russia. As we are in Russia, in a few days ago, the ruble saw its all-time low just on the eve of the election, and then it gained back about 10%. So all these moves, how can they be explained, and what to wait for in these markets?
Well, as you know, emerging market is a very heterogeneous investment area. In general, the dollar has weakened. I haven't shown the chart, but has weakened. That's positive for emerging market economy as such. Then most, not all, but most are not expensive. Most of them do show signs of recovery. And then it depends, obviously, in the detail, if you have a strong connection to commodities and oil, or if you are like China, rather an importer of that and more in the technology area. later obviously helps more. The main problem is for Russia, I do see the dependency of the oil sector, and to a certain degree, but only to a certain degree, of commodities. And there you depend heavily on the price movements. It looks to me that the demand supply in the oil sector is still not in a balance. So there's more supply than demand, and there's not enough cut of production, and there is also not enough growth to support higher or much higher prices. So it is really hard to come then to what you've asked, to Russia, because some areas will do well. We are mainly invested in corporate bonds, hard currencies. They do pretty well. I mean, we could even say Russia is a developed country if we look at ratings, or at least mostly, not everything. If I were right, and the recession will be over in Q2 next year, also in Europe, probably the demand supply on the oil side and the oil price will move up, and might support your market more. I personally prefer, for the time being, some areas in Asia, excluding India, and I think that there is a catch-up trade in Brazil, although they have similar problems, or let's say sectors like Russia. I am watching since years your index, and so far, unfortunately, the move is not yet reflecting my hopes. So I'm a bit careful for the Russian equity market.
Okay, well, we have come to the top of the hour, but probably the last question is, as you mentioned, that there has been a major sell-off in the gold recently, and we've seen that gold has been rallying recently in mid-year. What could be said about other alternative investments? Previous time, some people were asking about Bitcoin, about other alternatives. What should they behave? How do they behave now?
I mean, Bitcoin, for me, I'm sorry for all the fans of Bitcoin. I think this is A, bubble, and B, not real, and C, disclaimer, I might be wrong. But I'm not touching them. On the other hand, copper, it looks interesting, which fits to my narrative that the economy might grow. We have seen yesterday a tremendous rally in REITs, also real estate. I prefer, honestly, residential REITs. They look more attractive, and they are less affected by the economic swing. Having said that, the negative is probably priced in, so REITs is a thing you can consider. There are people who bet in banks and insurance, in particular in Europe. If there is a catch-up, yes, why not? Then there is a lot of money flowing into private equity. There are good opportunities around, but there's also a lot of money chasing. So it depends on the manager, the provider of your products, but you could consider that. I do like private debt and European hybrids, so subcategories less liquid of the bond space, which you might consider. What I've said before, just in two words, but corporate bonds, non-investment grade, but higher non-investment grade still offer you a certain yield. Gold, I personally believe midterm it goes up. At that moment, the chart is vulnerable because we are below the 100-day average. Might go down to the 200-day, but really nobody knows. This can also fast mean revert. It depends if we get, for instance, a negative news from another provider of a vaccine or from Pfizer that they might not get the approval next week, and immediately everything turns upside down.
Yes, that's right. Maybe one more question could be the last question that we keep being asked about the long-term perspectives of the oil and gas, which have high importance in this region.
Yeah, I mean, this is a hard question, but the point is that since 2016 Paris, the global agreement, Biden has already announced that he will rejoin this global agreement, so the global warming and the fight against it. New energy, I don't know if you are aware of it, but in America there is an ETF trading on the accessible clean energy index, up more than 100% year to date. So in a nutshell, you will not replace overnight oil, gas, and coal, but midterm there will be less demand, and you will be forced to invest into greener stuff or to isolate your house, etc. Therefore, if you buy such companies, you have to see what is the dividend yield, what is the free cash flow, and what are the production costs, because there will be more taxes on it and you will be banned and banished. This won't happen overnight, but the outlook midterm has rather worsened since Biden is president.
Okay, Andreas, thank you very much for this update, for this monthly macroeconomic update that is covering October and November and the upcoming months. And again, hope we will see you another time this year, hopefully in December, to see how the forecasts will change. And let me remind the viewers that the recording of this event, as well as of all others event, will be available on the website to members of CFA Association Russia and members of several CFA societies worldwide. And please look at our calendar. We have several exciting events coming up, and hope to see you in our studio again. And thank you again, Andreas.
Thanks a lot for having me.